This is Financially Fit Business with Ruth King.
Welcome to the Financially Fit Business Podcast. Here you discover ideas, tactics, news, and information that matters to the health of your business or your client's business. I'm your host, Ruth King. Here is how we will help you increase the financial fitness of your businesses today. In the previous episodes, I gave you the first 6 parts of a financially fit business: tracking, looking at overhead costs per unit of revenue and net profit per unit of revenue, pricing, recurring revenue, metrics, and budgeting. In this episode, I'll discuss the final part, financial review. Let's get started. Okay, you have done the P&L and the balance sheet for your clients, or your CPA has done it for you and it's time for review, or maybe an internal bookkeeper controller does the P&L and the balance sheet. So what does the financial review really and truly look like? The way I do financial reviews is I look at them totally graphically. I don't look at data in terms of numbers. I look at data in terms of graphs. I have found over the years that so many people don't get numbers. I mean, we get them. And we've talked about this in the past because we're numbers people. Most business owners are not numbers people. Now, there's the occasional business owners who just, more than likely they're engineers because they're numbers driven. But most business owners are not numbers people. And if you show them a sheet of a P&L and a balance sheet, they're likely to throw it in a drawer. Well, no, they'll look at the bottom line of the P&L and go, yep, I made a profit this month. Throw it in the drawer, never look at the balance sheet, and it's done. Until next month, and they look at it and they go, yep, did that. Now, hopefully you're having a budgeting review with them so that you should at least get them that way, so that they look at where they are from an actual and a year to date and see whether they're going to make budget for the year. But the best thing to do is to break it up into 2 distinct pieces and look at it from a P&L perspective and look at it from a balance sheet perspective in terms of trailing numbers, in terms of graphs. So we look at trailing numbers, which is a year's worth of data taken a month at a time, so that you can see the trends of a business. So, for example, the revenue point for October of 2025 is November of 2024, December 24, all the way through October 25, and together divide by 12. The reason that we do trailing 12s is that it evens out all seasonality in businesses for those businesses that have seasonality, but it also will let you see the long-term trends of the company. Yes, we do the monthlies, and so that you see monthly trends as well as the trailing trends, and hopefully they're both going in the same direction. So from a P&L perspective, I do look at it from the overall data, and I look at it from obviously revenue, gross profit, overhead, and net operating profit. And the revenue line and the gross profit line should be parallel and hopefully increasing, but there's a lot of companies who are what I call in stasis, and they're really happy. They don't necessarily want to grow any more than the rate of inflation. That's fine. It's their business. Their name's on the door. They write the checks. Okay. The overhead line should be fairly parallel. And then obviously the net operating profit line will be the same general shape as the revenue and gross profit line, assuming overhead is parallel and revenue and gross profit are parallel from there. So we look at the overall graphs to see where they are, both from a monthly perspective and an overall perspective. But we also look at other things. We look at gross margins, because gross margins are really important to make sure that the company is stable with respect to pricing. And if it's going down, we have to figure out why it's going down. If it's going up, what are we doing to make it go up? I mean, either up or down is good or bad, but why is it good or why is it bad? And these are the conversations that you have to look at it on a monthly basis. We also look at net profit per unit of revenue. Again, hopefully it is going up and positive, but if it's not, why not? If it's going down, what's going on? Why is the company less profitable than it was in the past? And then we look at a final graph with respect to productivity, and that is for every dollar of revenue, how much you're spending on payroll and payroll taxes. And this is the counterintuitive graph. And what do I mean by this? Going up is not the right way, and going down is the good way. So think about this. If your productivity ratio, your compensation ratio, both are called the same thing, is 30%, that means 30 cents of every dollar is spent on payroll and payroll taxes. If it goes to 60%, that means 60 cents of every dollar is going towards payroll and payroll taxes. It's going the wrong way. It's increasing. All right. We want it to go the right way, decreasing, or staying at 30%. If it was at 40 and we went down 40% and we went down to 35% and down to 30%, we're heading in the right direction. Okay. So this of all the graphs, and it's probably the toughest graphs for business owners to wrap their head around because it is counterintuitive. Increasing is not good. Decreasing is good. And, we're so used to, especially with the gross margin graphs and the net profit per unit graphs and the overall P&L graphs, where, increasing is good and decreasing is not necessarily good. And this is the one counterintuitive graph that has to be kind of thought about for a second. But once you realize it, okay, yeah, if it's 30%, 30 cents out of every dollar, and it went to 60 cents, increase, that's not a good thing. And once they understand it from that particular perspective, then they are understanding it and watching the trends. So after the break, I'm going to give you the balance sheet items for financial review. We'll be right back. Thanks for listening to the Financially Fit Business Podcast.
Financial advisory services are the key to the longevity of the accounting profession. If you want to get started providing advisory services or want a review of a finance course you took in college, Ruth King's manual, Understanding Financial Trends Analysis, might be your first step. This manual gives you the information you need to help your clients with their financial statements, a great start or addition to your financial advisory practice. You help them with clarity on their business's financial health, the ability to spot impending issues and resolve them before they become a major crisis. Less stress and sleepless nights worrying about the financial part of their business. Your Financial Statement Trends Analysis Manual is the reference guide. What do you want in your financial advisory services practice? Click on the link below for more information and to order.
We're back. Thanks for listening to the Financially Fit Business Podcast. Before the break, I gave you the financial review for the P&L part of the financial statements. And then we also have the balance sheet. So the balance sheet, I look at liquidity ratios, I look at debt ratios, I look at usage ratios, and I look at working capital ratios. I separate working capital from the liquidity ratios. Yes, it's still a measure of liquidity, but I put it separately because to me, that is the most important indicator of the health of a company. So let's talk about the liquidity ratios. Obviously, there is the current ratio, which is current assets divided by current liabilities. There is the asset test or the quick ratio, which is current assets minus inventory divided by current liabilities. And then there's accounts receivable to accounts payable. So current ratio is really another measure of profitability. And as we all know, increasing means more, for the most part, increasing profitability, except for non-operational events like buying and selling assets, buying and selling companies, infusions into the company, things along those lines. But from an operational perspective, increasing current ratio generally means increasing profitability. Decreasing current ratio generally means decreasing profitability. From the asset test or the quick ratio perspective, both mean exactly the same thing. If the company has no inventory, then the current ratio and the asset test are the same. If there is inventory, it's current assets minus inventory divided by current liabilities. And the two lines, current ratio and asset test, should be parallel. That means that the company is using inventory properly for the most part. If their gross margin is consistent, these two numbers should be parallel. If they're spreading apart, that means that the company is building up inventory, and you want to know why. Okay. From the receivables to payables ratio, I do receivables plus cash for all companies whose revenues are COD more than 50% of the revenues. So if it's a company that's both residential and commercially oriented, and it's more residential and more collecting, when the services are done, then I add receivables plus cash, and I only use trade receivables. I also don't put in retainage for construction because you never know when you're getting your retainage. And then payables, in QuickBooks, we have payables and we have accounts payable and we have credit cards. If I add them together because they're both supposed to be paid within 30 days, and I'll leave it like that. And so then you have the receivables to payables ratio, and sometimes accounts receivable trade plus cash divided by accounts payable plus credit cards, and then increasing receivables to payables sometimes is good and sometimes it's not good. If there is a collection problem, which you would see in receivable days, which we'll talk about in a bit, then it's not good. But if the company is increasing revenue and billings and things along those lines, then you're in a situation where that number increasing is absolutely fine. If it's because you're getting more, you're not collecting receivables, it's a different story. Okay. So those are the liquidity ratios. And then I use the next ratios that I look at in financial review are debt to equity and long-term debt to equity. You want to know where the company is and how much debt they've saddled the company with. Long-term debt to equity is just long-term liabilities divided by equity or net worth or capital, whatever you call it. And in most small businesses, it should be less than 1. Okay, it might be increasing because profitability is decreasing. If equity is decreasing and you have negative profitability, the number is going to decrease and decrease and decrease. Okay, just be careful there. So debt to equity is just total liabilities, current and long-term liabilities divided by equity. And that number has a tendency to go up and down depending upon how busy the company is, whether they're starting large projects and things like that. As long as the long-term debt to equity is less than 1, generally the company is okay. The next series of ratios is what I call usage ratios, which is receivable days and inventory days. Accounts receivable days is from the time you send out an invoice to the time you get paid, how many days is it? And inventory days is from the time you from the time you buy a part to the time you use it, how many days is it? All right. So receivable days will tell you whether you have a collection problem. And sometimes clients have to be hit between the eyes with the 2x4. I had a client who I'm watching this number goes up and up and up and up and up. And I'm saying, you got to start collecting. We're too busy. We can barely get our bills out. True story. And so one day they had more than $1 million of accounts receivable and no money in the bank to pay the gas bill so that the people could get gas in their trucks to go to work. It was their hit between the eyes with the 2x4. It was their wake-up call, whatever you want to call it. But never again did they ever have a problem with collections because they hired somebody to do it. They could have done that before, but, they just didn't do it. We don't have to worry about it. Yeah, well, guess what? They found out they did have to worry about it. Inventory days are simply, you buy a part, you buy materials, how long is it to use it? My thing about small businesses is it should be under 30 days. And I do that because, if you look at a lot of the larger companies who have inventory down to a T, sometimes it's less than a day. Sometimes it's hours. So there's no reason in the world that you should have, as a small business person, unless you're a distributor or supplier, more than 30 days worth of inventory. Except also in extreme circumstances like COVID, when we couldn't get materials and you had to build up inventory to be able to function. A company I know bought $500,000 of generators and had generators when nobody else did. Well, they also had the cash to be able to do that during COVID. And sometimes foresight like that works really, really well. Well, their inventory days went through the roof. And obviously it went back down to normal as they sold the generators. Now, my last and favorite financial review graphs are working capital, which is simply current assets minus current liabilities. Your current your working capital is really the true health, in my book, of a company. If it's going up, the health of the company is going up. If it's going down, profitability is going down, and making sure that we figure out why profitability is going down is incredibly important, because you don't want working capital to hit zero or close to zero, because at that point it's robbing Peter to pay Paul, having problems paying payroll, cash flow being a huge issue at that point. Let it go, watch it going up and watch it going down. It's interesting because you can look at potentially buying companies when the working capital is going up. A client of mine, working capital goes up and up and up. Okay, I've got enough money to buy a company. Literally. Goes out and looks for a company to buy, buys it for cash, working capital goes down. Those companies start operating profitably again, and again, working capital goes up. Time to buy another company. Boom. So it's an interesting way of looking at working capital and making sure you have enough cash to be able to go out and buy a company, but it actually does work. So those are my parts of financial review. You're looking at, from the overall P&L, you're looking at gross margin, you're looking at productivity, net profit per unit, and on the balance sheet side, liquidity ratios, debt ratios, usage ratios, and working capital separate from that. So these are the steps that I use and I consider parts of a financially fit business. It's basically tracking, looking at overhead costs per unit of revenue and net profit per unit of revenue, pricing, recurring revenue, metrics, budgeting, and financial review every single month. If you would like information on how to do the graphs, go to financiallyfit.business. All the information is there. It's easy. You can do the graphs in less than a minute. Thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email ruthking@financiallyfit.business. Thanks for listening. Have a great and profitable day.